The $15 million real estate raise you're about to start will fail because you're choosing your capital advisor based on network size instead of process discipline. And that mistake will cost you 12 to 18 months and burn institutional relationships you'll need for your next deal. Now, this is for developers and real estate sponsors raising $10 million to $15 million who've done this before and got burned by advisors who promised connections but delivered chaos. You know that weak processes don't just slow raises, they damage your credibility in family offices with the very institutional LPs that you want to stroke a check. Now, the market shifted in 2025. CBRE projects commercial real estate investment volume will reach about $562 billion in 2026, but over 70% of capital is concentrated in deals above $50 million. You're competing for a smaller, more selective LP pool. The advisor you choose controls that first impression. Choose wrong, and you'll spend the next 18 months explaining why your last process was a disaster. So I'm going to show you the 4-part selection framework that separates advisors who improve close possibility from those who destroy institutional relationships. Okay, chapter 1, what retainer structure should I expect? Retainers for institutional capital advisory at the $10 million to $15 million mark run anywhere between $25,000 to $150,000. That's table stakes. The term that matters is whether the retainer credits against your success fee at close. A retainer with no credit means your advisor gets paid regardless of outcome. That's misaligned from day one. They'll move fast to collect monthly fees instead of building a disciplined process. When IRC Partners reviews engagement letters, we see this structure kill raises because the advisor has no economic incentive to be thorough. The credit structure should be implicit in the letter. Full retainer credit against success fee or partial credit with a floor. Never accept a retainer that stacks on top of success fees. Here's why this matters more than the dollar amount. So an advisor earning $20,000 per month with no success fee credit will prioritize monthly collections over close outcomes. And that behavior shows up in rushed LP outreach and weak diligence preparation. Now, next, I'll show you why the tail period in your advisory agreement determines whether your advisor rushes your process. Chapter 2, how long should a tail period be? So a standard tail period runs 12 to 24 months after engagement termination, with 18 months as the market norm for mid-market raises. Anything shorter than 12 months creates perverse incentives. Here's what happens with a 6-month tail. Your advisor knows they lose commission rights in 6 months. So they rush introductions before materials are ready. They push for LP meetings before your data room passes institutional standards. That's how you burn family office relationships on preventable mistakes. 18 months gives your advisor time to run proper process discipline without panic. It also reflects the reality that institutional LP decision cycles can stretch 6 to 9 months from first meeting to close. When IRC Partners negotiates tail period, we see 18 months as the sweet spot. Long enough to prevent rushed processes, short enough to maintain accountability. If an advisor pushes for 24 plus months, they're optimizing for commission collection over close probability. The tail period reveals whether your advisor thinks in terms of transaction cycles or relationship building. Chapter 3, what happens in the 60 to 90 days before first investor meetings? A disciplined advisor runs a 5-step pre-outreach sequence: data room audit, narrative refinement, financial model, self-testing, diligence gap identification, and objection mapping. An undisciplined one moves straight to outreach. Here's the diagnostic question. Ask what specific steps they complete before the first LP call. If they can't map out this sequence, they will cost you institutional relationships when LPs find gaps your advisor should have caught. Data room audit means reviewing every document an LP will request and identifying missing pieces before outreach begins. Narrative refinement means stress testing your investment thesis against institutional objections. Financial model review means catching errors before they surface in LP diligence. When IRC Partners takes a mandate, those first 60 to 90 days determine whether the raise succeeds or fails. We've seen deals die because advisors rush to outreach without completing the sequence. One family office meeting with a broken data room and that LP is out permanently. You only get one chance to do it it right. Process discipline in those first 90 days separates advisors who understand institutional capital from those who just know how to make introductions or blast a deck. Chapter 4, how to evaluate if an advisor's network fits your specific deal. The advisor should identify before signing which specific LP types fit your asset class, geography, and check size. Vague references to a broad network of family offices, they're not answers. A multifamily ground-up development in a secondary market requires different LPs than an industrial acquisition in a primary market, for instance. If your advisor cannot articulate that distinction, their outreach list will be wrong from day one. Spray and pray. Now here's the test. Ask them to name 3 LP types that are best fit for your deal and explain why. They should reference check size preference, geographic mandates, and sector allocations. If they give you a generic network claim, they don't understand investor match logic. IRC Partners maintains LP databases segmented by deal criteria because precision targeting beats volume outreach every time. One well-matched LP introduction is worth 10 generic ones. Your advisor's ability to make those distinctions before outreach determines hit rates. And the network question isn't who do they know, it's how precisely can they match LPs to your specific deal characteristics. Chapter 5, what economic alignment terms to negotiate. So fee structures shape behavior. Success fee triggers tied to introductions made reward activity, not outcomes. Triggers tied to close reward results. Retainer credits, we covered. Success fee triggers are the next critical term. Introduction-based triggers create perverse incentives. Your advisor gets paid for making calls, not closing deals. That leads to spray and pray outreach that burns LP relationships. Equity component matters for long-term alignment. An equity-aligned engagement typically includes advisory equity grants of 3 to 5% tied to long-term outcomes rather than a single close. When your advisor holds equity across future events, they won't rush your current process to chase their next mandate. Exclusivity should be mutual or include performance milestones. One-sided exclusivity with no delivery requirements gives you all the risk and none of the leverage. When IRC Partners structures engagements, we optimize for outcome alignment, not fee minimization. Advisors aligned with your long-term success will protect GP economics through the raise process. Chapter 6, same advisor for multiple raises versus deal-by-deal hiring. Continuity has compounding value in institutional capital raising. LPs who meet your advisor on the first deal already have relationships when the second deal arrives. Just makes sense. Deal-by-deal hiring resets that relationship capital each time. So here's the hidden cost of rotating advisors. Every new engagement requires LP relationship rebuilding. Institutional allocators prefer working with familiar intermediaries who understand their mandate evolution over time. An equity-aligned advisor like IRC Partners solves this through structural incentives. When your advisor holds equity across multiple assets, they're motivated to move long-term LP relationships that benefit your entire portfolio. IRC Partners tracks this through our closed deals. Repeat clients see 40% faster decision cycles on subsequent raises because LPs already know your process and diligence standards. Just makes sense. That relationship capital compounds over multiple capital events. The choice between transaction advisors and capital partners determines whether each raise gets easier or starts from zero. Chapter 7, what equity percentage should an equity-aligned advisor receive? Equity-aligned advisors typically receive 3 to 5% tied to long-term outcomes rather than single closes. This isn't a premium fee structure. It's a structural answer to the misalignment problem that makes most advisory engagements underperform. The percentage should reflect the advisor's role in capital stack structuring, not just distribution. They're handling waterfall optimization and GP economics protection. 5% is justified here. If they're only making introductions, 3% is the ceiling. Equity grants should vest over multiple capital events, initial close, stabilization milestones, and exit. This prevents advisors from optimizing for quick closes that compromise long-term value. IRC Partners structures equity grants with performance triggers tied to LP satisfaction metrics and portfolio outcomes. When our success depends on your long-term performance, we'll never push deals that maximize maximize fee but minimize value. Pure fee-only models favor speed over structure quality. Equity alignment ensures your advisor cares about post-close relationships. Chapter 8, how to test process discipline before hiring. 5 scenario questions reveal process thinking versus experience claim. What happens if first round LP outreach produces soft interest but no commitments? Strong answer describes repositioning protocol. Weak answer describes following up with the same list. Can you show me a closed process at similar raise size? Mandates are easy to claim. Closed processes with documented LP commitments are harder to fabricate. Ask for anonymized closing timelines and conversion ratios. How do you handle LP pushback on governance terms? Now, this tests whether they understand post-close relationships. Advisors who only run introductions cannot answer this well. What experience do you have at the $10 million to $50 million raise band specifically? LP decision dynamics and diligence timelines are different at this level. Relevant project experience outweighs total volume claims. Does your engagement letter cover future capital events? This is a big one. This reveals whether you're hiring a transaction intermediary or you're hiring a capital partner like IRC Partners. So the advisor you choose controls your first impression with the institutional LPs in a market where over 70% of capital flows to deals above $50 million. Choose based on process discipline, not network size. Your raise will succeed or fail based on whether your advisor can survive institutional diligence in 2026's selective capital environment. So if your raise is $5 million to $250 million or more, and you want to know if your deal is institutionally ready before you sit across from an LP, or you want help getting from where you are to where you want to be, which is closed capital, I'll leave a link in the description. You can apply for a call. We review structure, your terms, and your capital stack before you walk into the room. Book a call with us now on that link in the description, and we'll see you there.